Okay, for this video, I'm going to cover a relatively complex topic. It's concerning single-member LLCs that are owned by non-residents and they're opening U.S. stores, either through Amazon, Shopify, or one of those other platforms. And what a lot of non-residents are seeing is that even though they have a U.S. LLC, they can't actually open the account in the LLC name and tax ID number, which is a problem. So I've got a lot of restructuring options here. You'll notice here in the top right, I've got 10 total slides. So it's quite a few slides, but I promise you they're all going to cover a lot of different options and they're going to be very helpful. So I encourage you to stick through to the end. If you aren't already subscribed to the channel, please do so. And if you are subscribed and I can see that and you have a question and you leave a comment on the video, I'll answer them, right? So that's the cost of admission, is you've got to be subscribed to the channel. And if you do have a comment or question, I'm happy to answer those. So slide 1 here, some of the background, and then we'll jump into some of the restructuring options that I've got on slides 2 through the rest of the deck here. So the Amazon seller account can be opened as either an individual or an entity. So obviously individuals are the easiest. If you have a U.S. person and you just want to open an account in your name, you can do that, and you would complete IRS Form W-9. You use your personal name, address, and SSN, right? Very straightforward. Non-U.S. persons is the same approach, right? You as a non-resident can open an individual account through the Amazon seller platform. You would complete an IRS Form W-8-BEN, and you would use all your personal information. Now, most often you try to avoid that because you don't want your personal name on the store, right? You have your own branding, you have your own store, you want a legal entity. So if we set up a legal entity to open the Amazon seller account, what are our options? Okay, so let's look at a U.S. corporation. A U.S. corporation, so let's say a Delaware Corp, is automatically a U.S. tax resident for federal tax purposes. And this applies no matter how many shareholders you have or where they are resident. So if you go to open an Amazon seller account with a U.S. corporation, you're going to complete a W-9 and you're going to use the corporation's name, address, and EIN. And that's because the corporation it's a regarded entity, meaning it's standalone from the owners, and it is a U.S. tax resident, so you're completing the Form W-9. Now, another option is to use a foreign corporation. So if you form a corporation outside the U.S., so let's say it's a Switzerland GmbH, which is a foreign corporation for federal tax purposes, that entity can open a U.S. Amazon seller account, and in that case, it would complete IRS Form W-8-BEN-E, and it would use its foreign address and foreign tax ID number and the name of the corporate entity. So if you're a non-U.S. individual, you can use a foreign corporation to open that account, and that'll keep your name off the seller's store. The third option here is a U.S. LLC with multiple owners. So a U.S. LLC with more than one owner is by default a U.S. domestic partnership for federal tax purposes because it's a multi-member LLC. A U.S. domestic partnership is a regarded entity, and so it can open an Amazon seller account in the LLC name, address, and EIN. And so it's going to complete its own Form W-9, and this applies regardless of the residency of the members. I have a separate video, which I'll link below, where I talk about the difference between W-9 and W-8-BEN for U.S. domestic partnerships. But what's important here is if this is a U.S. domestic partnership, it's a regarded entity, it completes a W-9, regardless of where the LLC members are tax resident. That's very important. Remember that, because that's going to come into play when we look at these different structuring options. Now, last but not least, and this is where all the problems arise, a U.S. LLC with one owner is a disregarded entity. So a single member LLC, one owner, is by default a disregarded entity for federal tax purposes, which means the LLC legally exists, but it's completely transparent for federal tax reasons. So if an Amazon store is open using a disregarded LLC, the owner is the one that's completing the withholding certificate, not the LLC itself. So this is where Amazon basically looks through the LLC and it displays the beneficial owner's name and not the name of the entity. Now, this is obviously a problem because owners don't want to have their personal information on the store. It looks unprofessional, right? You want to have a storefront with a legal entity name, not your personal name. And it reveals your identity, right? If you want to use a Delaware LLC or a Wyoming LLC that preserves your privacy, if it's disregarded, all of this is a moot issue now because you have to disclose your name as the owner. So that's the issues that we're presented with. Let's start looking at some of our options. Okay, so what are some of the restructuring options? I've got 5 in front of us. Now, the restructuring options are going to depend upon the tax residency of the owner, whether it's U.S. or non-resident. These 5 options are going to be directed towards non-U.S. owners. Okay, so if you're a U.S. person and you have a single member LLC that's disregarded, you can still use these options, but I've laid these out directly for non-resident owners that are setting up Amazon seller accounts, for example. So the first one we're going to look at is simply filing an entity classification election. So this will change the LLC to a corp. The second one that we'll look at is opening a foreign corporation and transferring the LLC units to that foreign entity. The third option that we'll look at is opening a second U.S. corp and adding it as a member to the LLC, which is going to create a partnership structure. Fourth option is to create a trust. This can be either a U.S. Domestic or a foreign trust. It has to be non-grantor for federal tax purposes. I'll talk about that a little later. And then you can add the trust as a limited LLC member to the existing U.S. LLC, which again creates the partnership structure. And then last but not least here, option 5, we're going to form a foreign corporation and add the foreign entity as a limited LLC member to the existing U.S. LLC, which will also create that partnership structure. Now, what's important here, and I have this noted, you must always assess the potential U.S. tax issues for each structure. Okay, so I'm going to talk about generally what each one will require, but your individual facts and circumstances are going to drive ultimately whether you have to pay tax under one of these structure options or not. Okay, so very, very important that after looking at all these and considering them, you still need to do a deeper dive and analyze to what extent are you engaged in U.S. trade or business? Do you have U.S. source ECI? Are there other U.S. FDAP income withholding tax issues? So don't just look at these structure options in isolation and move forward with one. You still need to consider all the federal tax implications that can arise given each option. Okay, so let's move on to option 1. Okay, so what's option 1 going to look like? Again, we're going to simply file an entity classification election. So if you have a single member LLC with a non-resident owner, you can file 8832, this is the entity classification election, and elect C corporation tax treatment. Once you do that, the LLC is now a regarded entity and treated as a U.S. tax resident because it's a C corporation for federal tax purposes. When you complete your Amazon seller account tax interview, you're going to use the LLC name, address, and EIN because when you complete the Form W-9, it's going to be as a U.S. tax resident, right? So this is the key point here. Once you make this election, even though it's a single member LLC, it's no longer disregarded. What you've done is you made your LLC a U.S. tax resident by creating a C corporation tax treatment at the LLC level. Okay. Now, once that occurs, the LLC has to now file 1120 tax returns, right? This is a U.S. corporation. So it's going to file Form 1120s every year, and it's going to pay U.S. income taxes on its net taxable income. And U.S. tax residents, this is U.S. individuals or U.S. corporations, pay tax on their worldwide earnings. So the gross income that's running through that LLC minus its expenses is now all going to be subject to U.S. tax. So this option is certainly on the table, but in a lot of circumstances, it's not ideal because if you otherwise wouldn't be paying tax at the U.S. level, you now will be if you make this election. Now, dividend distributions from the LLC to a non-resident shareholder, this is going to be U.S. source dividend income, which is subject to withholding tax of 30%. This is the U.S. FDAP withholding rules. That's fixed, determinable, annual, or periodic income. The U.S. source dividends are reported on 1042 and 1042S, and the withholding tax is paid to the federal government. Okay, now the 30% rate can be reduced depending on the residency of the shareholder, right? So what we're looking at is, does a tax treaty apply? If the shareholder is a resident of a treaty country, let's say like the UK, you might get a 15% rate, rather than the base 30% rate. So what's the impact of this structure? Well, what changes here is the LLC can now complete Form W-9 and display its legal entity name, address, and EIN on the storefront, right? So as I noted above there. So you're no longer displaying the name of the owner on the storefront. This is what you want, right? You want to set up a separate entity to be the storefront name. You don't want to have your personal information displayed all over Amazon.com. Now, the LLC, again, it's a U.S. tax resident. So because it's a U.S. corporation for federal tax purposes, it's filing 1120s, and it's going to pay tax on its net taxable income. And then again, the dividend distributions, they're going to be U.S. source dividends, so they're subject to withholding taxes. Okay, so that's option one. Again, certainly on the table, and I have a lot of clients that go this route for other reasons too, but this might not be ideal if you're trying to limit your U.S. tax exposure. Okay, so let's move on to option two. Okay, so option two here, opening a foreign corp. You can open a foreign corp and make sure it's treated as a foreign corporation for federal tax purposes. What I mean by that is the foreign corporate entity, if it's by default a foreign corporation, leave it. You don't want to file an entity classification election to change its status. So if you open a foreign corporate entity, transfer 100% of your LLC units to the foreign corporation. This is the structure we're looking for on the bottom here. So what happens? The LLC still exists, and it still remains a disregarded entity. What's changing, though, is now it's beneficially owned directly by the foreign corporate entity, which is a regarded entity for federal tax purposes, and you as the non-resident owner are on the other side of it. So effectively, there's this foreign corporation buffer in between you. Now, why is that ideal in this case? Well, it's ideal because now this Amazon seller account is open using the name of the foreign corporate entity because it's the beneficial owner. No longer is the non-resident individual the owner. Okay, so if you're, again, looking to keep your individual name off the storefront, stop using your individual information, you can insert a foreign corporation into the middle here, still leave the LLC. In this example, we have a Wyoming LLC that's a disregarded entity. That's between the foreign corp and the Amazon seller account. But at least when we complete the tax interview, it's being done using the foreign corporation name and not the non-resident individual shareholder. Okay. Now, as far as filings go, if the foreign corporation is not engaged in a U.S. trade or business and has no U.S. source ECI, then this entity doesn't need to file an 1120-F. If, however, you determine that you are engaged in U.S. trade or business and have ECI, then you're going to have to file. And again, that discussion is beyond the scope of this video. I have other videos that cover those issues, and I always recommend that you have a consultation with a tax attorney that specializes and focuses in this space because it is really a really rigid facts and circumstances test. There is no bright line rule. Okay, so that's option two. Let's have a look at option three. So option three, we open a second U.S. corporation and add the second corporation as a member, let's say a 1% owner, to the existing LLC. So we create a U.S. corporation. The non-resident is the sole shareholder. Add the U.S. corporation as an LLC member to the existing LLC, which creates a multi-member LLC for federal tax purposes. Now, remember, when we have a second partner come in and you have a multi-member LLC, it automatically converts to a partnership for federal tax purposes. Okay, so the LLC is no longer a disregarded entity. Now, this conversion is automatic. I'll include another link below that covers the automatic conversion rules, but once you add this member to an LLC, it automatically becomes a partnership. You don't have to file a Form 8832. That's another mistake I see a lot of practitioners make, is they believe that admission of the partner alone isn't sufficient. You have to file that 8832. Not true. It's very clear in the Treasury regulations that if you have a disregarded LLC that adds an LLC member, automatic conversion to a partnership. So once that conversion occurs, the Amazon seller account is open using the LLC name, address, and EIN. So now we have a U.S. LLC partnership that's a regarded entity. During the tax interview, the LLC is completing a W-9 using its legal entity name, address, and EIN. And so again, we now have the storefront showing the U.S. LLC information and not the owners. So what are the filings? Well, the LLC, because now it's a domestic partnership, needs to submit a 1065 tax return every year. And the U.S. corporation, that second entity we set up, must file an 1120, and it pays taxes on its allocable share of the income. So in the example structure we got in the next slide here, what we're going to do is we have Frank as a German citizen and tax resident, and he has an existing single-member LLC in the U.S., but he wants to implement this structure. So how does he do it? So let's look at the structure chart on the next slide here. So here we have Frank up here. He's the foreign person, right? We've got his Amazon seller account down here. And here's the U.S. LLC that Frank set up initially that he owned 100% of. So in order to make this LLC a partnership, Frank has to add a second partner. In comes the U.S. corporation. So if we think back to the previous slide, the steps here, Frank is going to open a U.S. corporate entity. This could be a Delaware corporation, Wyoming, Nevada, you pick. And he's going to own 100% of the stock. Now, the U.S. corporation is a regarded entity, right? It's a U.S. tax resident. It's taxed as a C Corp, so it's its own separate partner. So once Frank does this, he can transfer 1% of his units from here into the U.S. corporation, which creates a partner, or he can fund this entity with cash and have this entity contribute the cash and be added as a partner. The idea here is we want to create a two-person structure for this LLC. So Frank owns, let's say 99% as the managing member, and the U.S. corporation comes in. He can own just 1%. It doesn't have to be 50-50. It doesn't have to be 90-10. What we need to do is create a separate entity that's regarded that comes in as a second owner, and that's what creates this partnership structure. So notice here that Frank beneficially still owns everything, right? He owns 99% via this outlet here directly, and then this 1% is owned by a separate U.S. corp, but he owns 100% of the stock, right? And so this is how you create a partnership structure without adding somebody else. Like Frank doesn't have to add his brother or the guy down his street or anything like that. He owns this company outright, and it in turn owns 1% of this entity, and you've got this U.S. partnership structure. Okay, so again, the U.S. LLC is going to complete a W-9 because this is a domestic partnership. The LLC must file an annual Form 1065 every year because it's a domestic partnership. And the U.S. corporation up here is going to be filing an 1120 every year because it's a U.S. domestic corporation. And then so Frank, I have noted here, may or may not need a 1040NR. It really depends on what's going on here. If this LLC is engaged in U.S. trade or business and has ECI, then there might be some tax paid here. If it's not engaged in U.S. trade or business and has no ECI, then there's no tax liability filing for Frank. But regardless of whether you have U.S. TOB or ECI, this entity always must be filing in 1065. Domestic partnerships have got to file a 1065 period. No way around it. Okay, so that's option 3. Now let's look at option 4. Option 4, very similar to the previous one, only instead of creating a U.S. corporation, we're going to create a trust. So what if Frank here, a German citizen, wants to create a trust and add the trust as the 1% owner to the LLC? So in this example, he's going to create a U.S. trust. It's going to be a Delaware self-settled asset protection trust, which is going to be a non-grantor trust for federal tax purposes. The key point here is it has to be a non-grantor trust. Okay, whatever kind of trust you set up, this is a very precise type of Delaware asset protection trust, but it doesn't have to be. It can be a variety of other different kinds of trusts. It could be a charitable trust. The point is, it has to be non-grantor. If it's a grantor trust, then it just flows through to the owner anyway, and you don't get this partnership tax treatment that we're going for. Okay. Now, once the trust non-grantor is admitted, again, similar to before, the LLC automatically converts to a partnership, which is going to be a regarded entity. So same thing. It's no longer a foreign-owned single-member LLC that's disregarded. So the seller account, you can go ahead and do the same thing. The LLC's name, address, and EIN is used to open the account and to complete the tax interview. Okay. Now, the U.S. LLC must still file a 1065 partnership return each year, right, because it's a domestic partnership. And the U.S. non-grantor trust needs to file a 1041. Okay, so let me look at the next slide here for the structure. Look, you notice very, very similar. Everything is exactly the same except for this piece up here. So instead of a U.S. corporation, we created a Delaware trust, non-grantor trust. And again, because this is a self-settled asset protection trust, Frank can be the beneficiary, but he's going to have to appoint somebody else as the trustee. Don't get hung up on those details. The main point I want to convey here is this has just got to be a non-grantor trust. So whatever type of trust you set up, make sure it's non-grantor for federal tax purposes, and then this will work. If it's a grantor, then it's just look through the same issues you had before, right? If this was a disregarded entity, you would admit this, and then Frank would beneficially own 100% of this without a regarded entity in the mix. So it would defeat the whole purpose of the structure. Wouldn't work. So similar tax filings. Again, the LLC completes its 1065. The Delaware Trust completes a 1041, and it pays tax on its 1% allocation of the income here. And then Frank, again, whether he files a 1040-NR is really going to depend on the USTOB and ECI issues that either are prevalent here or not. So again, that's a whole different discussion, a much deeper dive into the activities that you're conducting within the U.S. Okay, so let's move on to last but not least, our option 5. Option 5, again, very similar to the two structures we've already seen before, only in this case, we're creating a foreign corp. So we create a foreign corp that's going to be added as the second partner. The non-resident forms a foreign corporation and is going to own 100% of the stock. After formation, transfers 1% of the units to the foreign entity. Okay, so again, the Amazon seller account is going to be opened using the U.S. LLC's name, address, and EIN. It's a domestic partnership, so it files a 1065. The Amazon storefront shows the U.S. LLC name, does not reveal the name of the owners, right? So these are all the things we're going for here. So in this example, we have Frank. Again, he's a German citizen. He's going to create a 100% owned Belize IBC, which is going to be treated as a foreign corporation. And then he transfers 1% of his LLC units into the entity. Okay, so let's look at option 5 structure chart. Again, very similar to what we've seen in the previous two options. We have the same Frank up here, the US LLC, and the seller account that we're opening. Frank is going to own 99% as the managing member. But in this case, instead of a U.S. corporation or a U.S. trust, we've got a foreign corporation, the Belize IBC. And again, it's got to be a foreign corporation for federal tax purposes. So it's a foreign corporate entity. Do not file an entity classification election to make it disregarded, because then again, it torpedoes the whole structure. Then Frank beneficially owns everything 100% without any regarded entities in the middle, which defeats the whole purpose. Then this entity cannot be a U.S. LLC. So this has to be treated as a foreign corporation for federal tax purposes. So same tax issues. U.S. LLC gets to complete a W-9 because it's a domestic partnership, and it's got to file a 1065 tax return every year. The Belize IBC accepts 1% allocation of the income. It's going to complete a W-8BENE. Now, it may or may not be filing an 1120-F. Same issue that Frank has over here. If this U.S. LLC is engaged in U.S. trade or business and has ECI, then there might be an 1120-F filing up here to pay tax on the allocable income, and Frank might be filing a 1040-NR up here. Okay, so again, if you determine that this U.S. LLC is not engaged in U.S. trade or business and has no ECI, then all you're doing is filing the 1065, and you give a K1 to each party, and then there's no filings at these levels. If that's not the case, then you might have some filings here. The other thing to consider is tax treaties. Again, you could have Frank in a treaty country where this entity is engaged in trade or business in the U.S., but Frank is taking a treaty position that he's not conducting a business through a permanent establishment, so he has to file, take a treaty position to not have to pay tax in the U.S. Again, I don't want to get too into those details because it's beyond the scope of this video, but this is generally what the structure is going to look like and what filings must be done. And then depending upon the unique facts and circumstances of the U.S. LLC, you might have filings up here at the foreign corporate level and at the foreign individual level. So that covers it for this video. I hope that was helpful. If you have any questions, again, please leave me a comment below. If you're subscribed to the channel and I can see that, happy to reply to your comment. That's the price of admission. So thank you for sticking with me to the end here, and I hope you have a good day, and I look forward to seeing you again soon. Thank you.